Today, we are going to get personal. We're going to dive into the economics of your wallet, and we're going to tackle a question that sounds really simple but is actually, surprisingly deep. In a world of digital everything, why do we still hang on to cold, hard cash?
I mean, really think about it. You've got some bills in your wallet right now. What are they doing? Absolutely nothing. They're not growing. They're not earning a single cent of interest. Honestly, from a pure numbers perspective, it's a terrible deal. So, why do we all do it?
All right, to get this, we have to remember what money is supposed to do. Sure, it's a medium of exchange. That's just a fancy way of saying we use it to buy stuff. But it's also supposed to be a store of value. And that's where things get weird. If money is supposed to store its value, why would we choose to hold it in a form that, thanks to inflation, is actually losing a little bit of its value every single day?
And that, right there, brings us to the core idea of this whole explainer, the big trade-off. Holding cash gives you something incredibly valuable, flexibility, or as economists call it, liquidity. You can use it anywhere, anytime, no questions asked. But, and this is a big but, that convenience comes at a price. It's called an opportunity cost. It's all the interest you're not earning, all the potential stock gains you're missing out on. So, to really get a handle on this trade-off, we're going to follow the breadcrumbs left by some of the greatest minds in economics. We'll kick things off with the game-changing ideas of Keynes, then see how guys like Baumol and Tobin refine them, and finally, watch as Friedman just blows the whole picture wide open, bringing us all the way to how we see it today.
All right, first stop on our tour, the legendary John Maynard Keynes. He's really the one who gave us the first modern, satisfying answer to our question of why we bother with cash.
You see, before Keynes, economists didn't really spend a lot of time on this. It was just what you did. But Keynes came along with his theory of liquidity preference, and his point was that holding cash isn't just something that happens to us, it's an active, conscious choice. We prefer the liquidity of cash for a few very specific reasons. So what are they? Well, Keynes broke it down into three simple motives. First up, the transaction motive. This is the obvious one. You need cash for your morning coffee, your lunch, your bus fare. Easy enough. Second, the precautionary motive. This is your just-in-case money, for when the car breaks down or you have an unexpected bill. And third, and this one's really interesting, is the speculative motive. This is holding cash so you're ready to jump on a fantastic investment opportunity the second it appears. But here's where Keynes's original theory had a bit of a wrinkle, especially that speculative part. In his world, the choice was pretty stark. You either held your extra wealth in bonds that earn interest, or you held it all in cash that earns nothing. It was an all-or-nothing proposition. And, well, we all know that's not quite how real people manage their money, is it?
Right. That all-or-nothing problem was exactly what the next wave of economists, the post-Keynesians, wanted to fix. They took Keynes's amazing foundation and said, okay, let's make this feel more like the real world.
And this is where William Baumol comes in with a totally brilliant analogy. He said, just think about your cash like inventory in a warehouse. A store manager doesn't want too much stuff sitting on the shelves, right? But they also can't afford to run out of stock. Your job as the manager of your own finances is to handle your cash inventory in a way that minimizes the total cost.
So what are those costs? Baumol said there are two big ones, pulling you in opposite directions. On one side, you've got that opportunity cost we keep talking about, the interest you're losing. But on the other side, you have the transaction cost. Think of this as the hassle factor, the time, the ATM fees, maybe even brokerage fees for selling a bond to get cash. Your goal is to find that sweet spot right in the middle.
So what does this balancing act look like on a chart? Well, it looks kind of like the teeth of a saw. You go to the bank or ATM, pull out a chunk of money, and your cash balance shoots straight up. Then, as you spend it, that balance slowly slopes down, down, until you're almost at zero. And then, bam, you pull out another chunk, and the pattern repeats.
Now, Baumol even wrapped this up in a neat little formula, but don't worry, you don't need to know the math. The big idea, the key takeaway, is that there are economies of scale in managing money. In simple terms, it means it's more efficient to be rich. A person who can pull out a large amount of cash less often is managing their inventory more efficiently than someone who has to make lots of small, frequent trips to the ATM. It's basically like getting a discount for buying in bulk.
So Baumol gave us an awesome model for our everyday spending cash. But what about the money we keep as part of a bigger investment plan? To figure that out, we have to turn to another post-Keynesian thinker, James Tobin.
Tobin looked at that all-or-nothing problem from Keynes and proposed a solution that today feels like second nature to any investor: diversification. He said, wait a minute, rational people don't put all their eggs in one basket.
They build a portfolio. They hold a mix of safe cash and riskier bonds. And why? To manage risk.
And this gets us right to the heart of all modern finance, the eternal tug-of-war between risk and return. Cash is safe. Its value is predictable, it's stable. Bonds, on the other hand, offer the chance for a higher return, but they come with risk. Their price can fluctuate. A smart investor is always trying to strike the perfect personal balance between the two.
Which leads to this really powerful conclusion. How much cash you decide to keep on hand isn't just about math, it's about psychology. It's a deeply personal decision that all comes down to your own tolerance for risk. So are you a risk-averse person who loves the safety of cash, or are you a risk seeker who is willing to hold less of it for a shot at higher returns?
Okay, so far, our whole journey has been focused on you, the individual, making choices. But what happens if we zoom all the way out and look at the entire economy? That's exactly what Milton Friedman did, shifting the focus from a single wallet to the demand for money across a whole nation.
Friedman's big move was to totally reframe the question. He said, hey, let's stop treating money like this weird special thing. Let's think about the demand for money just like we think about the demand for any other asset, like a car or a house. And he had this really fascinating idea that holding money is kind of like a luxury good. The wealthier we get, the more money we want to hold, not just to spend, but as a stable part of our overall wealth.
So with Friedman's perspective, the list of things that affect our demand for money just got way longer. Suddenly, it wasn't just about one simple interest rate. It was about everything. Our total wealth, the returns we could get from stocks and bonds, and maybe most importantly, what we expect inflation to do in the future. It's the whole financial picture.
And when you look back, you can see this amazing story unfold. We started by thinking about the simple costs of everyday transactions, which Baumol modeled so well. Then Tobin came along and layered in the crucial idea of risk. And finally, Friedman connected it all to the big picture of our total wealth. Each theory gave us a clearer, sharper way to understand why we do something as simple as holding cash.
So, after that trip through some of the biggest ideas in economics, where do we end up? Let's put all the pieces together and form our modern view.
Here's the single most important thing to take away. Money isn't just for spending. It's an asset. And our decision about how much of that asset to hold is actually a pretty sophisticated calculation. We're constantly weighing the transaction costs of not having it, like Baumol showed us. We're balancing the risk of putting our money elsewhere, which Tobin explained. And that whole calculation is influenced by our overall wealth, just like Friedman taught us. Cost, risk, and wealth. That's the modern answer.
And that leaves us with one final, massive question for the future. We live in a world of instant Venmo payments, tap-to-pay, and cryptocurrencies. The very definition of cash is changing right before our eyes. So how will these timeless ideas of cost, risk, and wealth adapt when the money in our wallet is no longer made of paper, but of pixels?